As of 1:30 p.m. Eastern Time on Friday, April 24, 2026, Supermicro Computer Inc., trading under the ticker SMCI, is currently priced at $26.75 per share, representing a significant intraday drop of 8.33% from the previous close. The trading volume has surged to over 46 million shares already today, which is nearly double the recent daily average, signaling a high-conviction sell-off as the market reacts to a sudden shift in the fundamental narrative surrounding the company. While most investors are staring at the red charts and wondering if the floor is about to fall out, the real story isn't just the price drop itself. It's a massive $1.4 billion hole that just opened up in the company's revenue projections. Reports have surfaced that Oracle, a major titan in the cloud space, has reportedly canceled a massive order for hundreds of high-end server racks. These aren't your run-of-the-mill servers. They were the ultra-expensive NVIDIA GB300 configurations that were supposed to be the crown jewel of Supermicro's 2026 fiscal year. When a contract of that scale vanishes overnight, it creates a ripple effect through the entire supply chain, and it's why we're seeing this level of volatility on the screens today. The expectation for a long time has been that Supermicro is the arms dealer of the AI boom, providing the physical infrastructure that giants like NVIDIA stock rely on to get their chips into the hands of data center operators. Investors bought into the idea that as long as AI demand was high, SMCI would be the primary beneficiary because of their speed to market and custom rack scale designs. But the reality we are facing right now is far more complicated. The cancellation of the Oracle deal suggests that the hypergrowth phase might be hitting a wall of logistical or competitive friction that the market didn't price in. It's one thing to have a backlog of orders. It's another thing entirely to see those orders evaporated by a client as large as Oracle, potentially shifting their business to competitors like Dell or HPE. If you look at how this is playing out across different trading platforms, from the retail-heavy Robinhood app and SoFi Invest to the more professional-grade Interactive Brokers platform, there is a clear divide in sentiment. Many self-investing enthusiasts are trying to catch the falling knife, seeing a $26 price point as a bargain compared to the highs we saw earlier this year. However, the institutional activity on the Fidelity trading platform and through Fidelity brokerage accounts suggests a much more cautious wait-and-see approach. We are seeing large blocks of shares moving out of individual brokerage accounts and into safer havens as the risk profile of SMCI shifts from a growth play to a turnaround story. Recent market movement has been dominated by this tension between massive revenue numbers and razor-thin margins. Just a few weeks ago, the sentiment was relatively positive after the company raised its full-year guidance to $40 billion, but the market is a what have you done for me lately environment. Today's 8% drop is a direct reaction to the fear that the $40 billion target is now at risk. When you have a company trading at a PE ratio that assumes perfection, any crack in the armor, like a lost contract or a margin compression, leads to the kind of aggressive selling we are seeing right now. Institutional investors are particularly concerned about the gross margins, which have dipped toward the 6% range, a far cry from the double-digit margins investors were hoping for during the peak of the AI hype. This brings us to a critical point in the analysis of SMCI. For those using online investing tools or seeking investment help, it's vital to understand that Supermicro isn't just a hardware company, it's a logistics and thermal management company. They specialize in high-performance server technology, particularly liquid-cooled racks that are essential for the next generation of AI chips. Their business model is built on being the first to integrate new chips from companies like NVIDIA stock into full-scale data center solutions. This first-mover advantage allowed them to dominate the early stages of the AI build-out. However, as the industry matures, the big cloud providers are becoming more price-sensitive and more demanding regarding reliability and delivery timelines. We've seen a lot of movement in the Fidelity ETFs and Fidelity mutual funds that track the technology sector, with many managers rebalancing their exposure to SMCI in light of recent governance concerns. It wasn't just the Oracle news that rattled the cages. It was the resignation of key board members earlier this year and the ongoing scrutiny from the U.S. Attorney's Office regarding alleged export violations. While the company has stated it is not a direct defendant in those legal matters, the noise creates a discount on the stock's valuation that is hard to shake. If you're managing a retirement account through Fidelity Iris or using the Fidelity mobile app to check your balances, these are the types of tail risks that can suddenly turn a winning position into a headache. For those of you who have been following this stock closely through the Robinhood stock trading community or active trading on SoFi, the question now is whether the current price represents a bottom or a temporary pit stop on the way down. The company's heavy reliance on a handful of hyperscale customers, meaning the giant tech firms, is a double-edged sword. When things are good, the revenue scales at a pace that is almost unheard of in hardware world. But when one of those giants walks away, as Oracle reportedly just did, it leaves a massive void in the manufacturing pipeline. This is why diversification within an individual brokerage account or using a robo-advisor like the SoFi robo-advisor is often recommended to mitigate the volatility of a single stock blowup. Looking ahead, the catalysts for a recovery are quite clear, but they require perfect execution. Supermicro needs to prove that it can maintain its relationship with NVIDIA stock and be the first to market with the upcoming Blackwell Ultra systems. If they can secure a significant new contract to replace the lost Oracle revenue, the narrative could flip back to growth very quickly.
On the flip side, the risks are equally sharp. If margins continue to slide toward 5%, the company becomes a commodity hardware seller rather than a high-tech infrastructure partner. This is a distinction that the market will reward or punish with extreme prejudice. I want to hear from you on this. Comment below how many shares of Supermicro Computer Inc. you currently hold in your portfolio and what your average cost basis is. Are you buying this dip on the Robinhood app, or are you moving your capital into more stable Fidelity ETFs until the dust settles? When we look at the broader landscape of online investment, it's clear that the easy money phase of the AI trade is over. Now we are in the execution phase. This means that every quarterly report, every guidance update, and every news leak about contract wins or losses will have a magnified impact on the stock price. Users on the Interactive Brokers platform are seeing high implied volatility in the options chains for SMCI, suggesting that the market expects more big swings in the coming weeks as we approach the next earnings date on May 5th. Expectations were that SMCI would be a $50 or $60 stock by now, fueled by a relentless stream of AI data center orders. The reality is that the company is fighting a multi-front war, defending its margins against competitors like Dell, navigating a complex regulatory environment, and trying to keep its largest customers from jumping ship. This contrast between the AI darling expectation and the struggling hardware integrator reality is exactly why the stock is sitting at $26 today. For those using Schwab Intelligent Portfolios or other automated investing sites, you might notice that your exposure to high beta tech stocks like SMCI is being managed through diversified baskets. This is likely the prudent move for most, but for the self-investing crowd using SoFi Active Investing or Interactive Brokers trading, the current volatility is either a nightmare or the opportunity of a lifetime. The difference depends entirely on your belief in the company's ability to fix its internal governance and stabilize its customer base. To wrap this up, the central insight here is that Supermicro is no longer a set-it-and-forget-it AI play. It has become a high-stakes turnaround story that is tethered to the capital expenditure cycles of the world's largest tech companies. The loss of the Oracle contract is a warning shot that no customer is guaranteed, regardless of how fast you can build a server rack. The contrast between the sky-high expectations of 2025 and the gritty reality of 2026 has reset the valuation of this stock. Whether you are using Fidelity Wealth Management for professional guidance or managing your own trades on the Robinhood Investments platform, the key is to watch the margins and the management's commentary in the upcoming May earnings call. That will be the moment of truth for SMCI, the point where we see if the company can bridge the gap between its ambitious revenue targets and the reality of its bottom line performance.